Director at AlfAccurate Advisors. Rajesh, hi. Good afternoon. Thanks a lot for joining us. Rajesh, in one of your funds that you manage, Infosys is your top holding. You can correct me if I'm wrong. But what have you made of this gradual and sort of slow P reset or sort of derating that we have seen in some of these stocks led by Infosys itself? Your thoughts?
Good afternoon, Anuj. Infosys is not our top pick, top holding. Infosys probably would feature in our top 10 holding, but not the top holding. In fact, we are probably, right now, as we speak, from last 1.5 to 2 months, we are underweight IT sector compared to benchmark. But having said that, I think what is happening in IT sector is people are questioning on whether the growth is going to sustain or not. And people are questioning whether the discretionary spend by the consumers, when I say consumers means corporates, I think there are only two levers. One is to reduce advertisement spend, and second is to reduce IT spend. Of course, it is a difficult choice because in either case, you are basically probably impacting your long-term business growth, correct? But that's basically where the debate is. If you look at, for example, many IT company stock prices, from pre-COVID to now, they are probably more than doubled. If you look at, of course, the earnings, they have not doubled in last 2 years. Probably they have gone up 60% or 65%, whereas market cap is more than double, probably 120% to 175%. In fact, there are many IT companies whose valuations were probably trading at branded businesses like Unilever India with PE of 45 to 50 times. Now, clearly, those things are never sustainable because these are not structural 30-50% compounded growth for next 10 years. It would be foolish to assume such kind of a growth. So I think the recent correction is a good correction, and of course we will again relook at it. If it corrects further from here, probably another 10-15% downside from here, then one can then start again relooking at it, but on a very, very selective basis.
Rajesh, what is catching your sort of eye, piquing your interest really? What's looking interesting from a longer term perspective, not tactical, not short term, but where things have corrected meaningfully and you find some comfort with valuations now?
Well, I think there are two ways to look at it. One, where valuations have probably stock prices have corrected, valuations probably have not corrected much because EPS also has corrected. So that is one sector where the growth is going to come back very strongly. That is automobiles and auto ancillaries. So that is one sector. Second sector where valuations have corrected, but growth has remained much stronger is banking and finance. The third sector where valuations have not corrected much, but it's the beginning of the growth cycle, and that's capital goods. And that is in detail we have discussed about capital goods and specialty chemical. If you look at the capital goods companies, we track close to 15 companies in capital goods, and 8 of them, the leaders I'm talking about, they've reported 20% plus order book growth. That's big number. And this is not the first quarter they've reported this. This is the 4th consecutive quarter. Probably is the highest order book growth I have seen in last 7 to 10 years. So I'm talking about companies like ABB or companies like Thermax or companies like Timken or companies like Schaeffler, the kind of order book growth, the revenue growth, the margin resilience, and of course the strong automation which is happening. I think capital goods is one sector which, if you ask me, we have been positive or talking on your channel as well. We remain very bullish on this space.
Okay, so auto ancillary, financials, capital goods are long-term bets. And IT, you will relook at the IT sector to buy if the sectors and if the stocks fall about 10 to 15% further from the current levels. Rajesh, in the auto pack, what is it that catches your fancy? Which segment do you like?
I think in auto, if you ask me, the first preference should be commercial vehicle space. A number of reasons. First, of course, the base is in your favor. So if you look at last 4 or 5 years, the entire industry went through a big downturn, and probably the replacement cycle itself is going to give good handsome growth to this industry for next 2 years. Second is, as India economic growth start, particularly capex related growth starts, that leads to more demand for medium and heavy commercial vehicle. Third is the freight operator profitability, which was impacted about 1.5 years back. Now slowly it is improving, which is a good thing because he needs to make some money. The fourth thing, very important, the risk of EV, the disruption of EV. is probably least when it comes to commercial vehicle compared to two-wheeler industry. So while in two-wheeler, you are already seeing the launches from number of players on electric vehicle side, and commercial vehicle probably it is a 4, 5, 7 years away for a remarkable EV as a percentage. Probably it will take another 8 to 10 years. So if you keep in mind all these things, this is a space which looks reasonably valued with a good earnings growth, at least for next probably 2 to 3 years.
Rajesh, the issue is, especially in financials, since you mentioned, stocks have been all over the place. You've had an ICICI Bank which had a good run, but HDFC Bank had a massive derating. Kotak didn't do anything for last 2 years. Even the blue-eyed boys for the market like Bajaj Finance and Muthoot have been punished severely. So what stocks in the financial space would you put your money on?
So Anuj, the companies which you have talked about, we are positive on those companies, and that's exactly what I'm saying. That's one basket where valuations have corrected, but there is no change in the underlying earnings growth, both quantum of earnings growth or the quality of earnings growth. On the contrary, if you look at the asset quality is becoming better. If you look at the non-food credit growth, the yesterday night print is improving. If you look at the provision coverage ratio, is one of the highest in last 10 years. If you look at the credit cost, is reducing incrementally and probably one of the lowest in last 4 years. If you keep in mind all these things and the stock prices have corrected without changing EPS, then it means the valuations are coming to your favor. So yes, you are absolutely right that the stocks have not done much. Many of the companies which you talked about, probably that's an opportunity. The margin of safety is coming to your favor. And that's the reason why you need to start looking at it when margin of safety is in your favor rather than buying the stock at the peak of the valuations.
Okay. By the way, Rajesh, I asked you about ideas from a slightly longer term perspective. Let's talk about short term, right? Steel, where there is a lot of pessimism which is getting built in, saying that margins are going to get crushed, etc. Earnings are going to get destroyed. The fact, though, is that we had, for example, I think JSW with us just some time back. They said that steel prices are down 10% from the beginning of April. But earnings estimates for the full year FY23 were 40-50% lower than Q4 22 annualized numbers. So nobody was expecting them to continue, steel companies to continue to post Q4 type of earnings quarter after quarter. So even after this kind of steel price fall, it's not as if there's going to be significant earnings miss, and that is essentially at the end of the day what matters. Do you think there's too much pessimism here? Is there a case for a bounce? Any thoughts?
I think, Prashant, what happens in industry like commodities, particularly companies which you are talking about, the industry which you are talking about, a lot of things depends upon not the company's ability to produce right quality of goods or not, but it is the hands of the government, both global as well as local. And the tariffs keeps changing. Like, for example, US has imposed huge import tariff barriers on Chinese goods. One of the reasons why India is doing so well in many parts, not only in commodities, probably few other segments as well, because China goods have become very expensive compared to Indian goods. Now, can you continue this assumption that those tariff barriers will remain like that? That's the first question. China has also imposed the export duty on its goods. So there is no enough exports happening from China because it is becoming expensive even from China's perspective. That is also creating a differently demand-supply equation. And commodities are particularly absolutely driven by the underlying commodity prices. And on the third hand, you have Indian government. And the same government has saved the steel industry when they were not doing good. And now they are doing exceptionally well. So, of course, they are trying to control the inflation. Now, point is, if you want to buy these companies, you need to predict US tariffs, you need to predict Chinese tariffs, and you need to predict Indian tariffs. I don't think we have a competence to predict any of this. And therefore, we do not invest in commodity stocks.
Rajesh, thank you very much for your insight talking about China. At least right now, it's the growth-sapping zero-COVID policy which is hurting global markets across. Thank you very much for joining in. Get into a break. As always, we'll come back and tell you what the dealing rooms are saying in our special segment, D Street Chatter. And we'll also get you a few ideas that you can buy today and sell tomorrow from our...
Welcome back.